Welcome to the deep dive. Today we're tackling a really interesting Forex trading system. It's called the 28 Pairs Currency Strength System, sometimes known as the double GP strategy.
That's right. And it promises something pretty big, scanning the entire Forex market, well, the main pairs anyway, using just one chart.
One chart for 28 pairs? That sounds ambitious. How does it even work?
Well, the core idea is to leverage the flow of individual currencies. We're diving into how this system claims to give traders an edge by focusing on genuine strength versus genuine weakness, cutting out a lot of the usual noise.
Okay, so this is for you if you've ever felt like staring at, say, just USD gives you only a tiny piece of the puzzle.
Exactly. It's about getting that full market view.
All right, let's get into it. The system argues that looking at a single chart, like our USD example, is fundamentally flawed. Why is that?
Because, well, you're only seeing 128th of the relevant market action. If USD is going up, you don't actually know why. Is the euro itself strong globally?
Or is the dollar just really weak?
Precisely. Or maybe they're both weak, but the euro is just, slightly less weak at that moment. You lack the full context.
And without that context, you could easily jump into a trade that looks good on that one chart, but it's actually weak fundamentally and just reverses on you, kind of trading with blinders on.
Totally.
Yeah.
So when this system talks about the market, what are we actually defining?
We're talking about the 8 major currencies: the US dollar, euro, Japanese yen, British pound, Swiss franc, and then the commodity currencies, the Aussie, Canadian, and New Zealand dollars.
Right. And those 8 combine to create the 28 main pairs that most people trade.
Okay, so the system's edge comes from understanding that the market overall has to be in balance, like total buying equals total selling.
That's a core principle, yeah. The main tool here, the Advanced Currency Strength 28 Indicator, or ACS28, is designed to track this. It looks at all 28 pairs simultaneously.
How does it do that? It sounds computationally heavy.
It constantly calculates the aggregate strength or weakness of each of those 8 currencies based on how they're performing across all the related pairs.
Ah, okay, so instead of me trying to eyeball 28 different charts.
Exactly. You get one chart showing 8 lines, one for each currency. If you see the euro line shooting up and, say, the yen line plummeting down,
Then buying URJPY looks like a pretty obvious high probability trade.
that's the idea. It consolidates the analysis dramatically.
All right, so we see the overall strength divergence with the ACS 28, but that's the trend, right? We need an actual entry signal. That's where this double JP comes in.
Yes, the double GP, or DGAP. But first, we need to understand a single GP.
Okay, what's a GP in this context?
So you have the currency strength line, the CS line, on the indicator. A GP is basically a sharp move, a burst of momentum in that line. It's defined by its slope, its angle over the last couple of periods.
Just any sharp move.
No, it has to be significant enough. It needs to have a steep enough angle, and this is related to something called the dynamic market Fibonacci 23 level, the MFib 23.
Okay, hold on. Market Fibonacci. That sounds different from the fib retracements I'd normally draw on a price chart.
It is completely different. That's a really crucial point. Forget standard fib levels on price. These MFib levels 23, 100, 161, 260, 161, they are applied directly to the currency strength lines on the indicator.
Applied to the strength lines. How?
They act as dynamic zones or thresholds based on historical and current market activity across all pairs. They measure sentiment, or maybe saturation is a better word. They're not fixed price points.
So the MFib 23 is like a minimum speed limit for the strength line to register a GAP?
Sort of, yeah, a velocity threshold. If the strength accelerates past that dynamic level, boom, you've got a GAP confirmed for that currency.
Got it. So back to the double GAP signal. Why 2 GAPs? Why isn't one strong currency moving away from a weak one enough?
It's about confirming genuine divergence with momentum from both sides. A DGAP requires 2 separate confirmed GAPs happening close together, but in opposite directions for the base and, quote, currency. Okay, let's say the Euro CS line registers a sharp downward GAP, breaking its MFib 23 threshold. And at roughly the same time, the New Zealand dollar CS line shows a sharp upward GA, breaking its own MFib 23 threshold.
Then you'd sell URNZD.
Exactly. You have confirmed downward momentum on the euro and confirmed upward momentum on the Kiwi. 2 distinct triggers.
Versus a single GP or SGAP, where maybe the euro is gapping down, but the Kiwi is just kind of flat or drifting slightly up.
Right. That SGAP trade is considered much weaker, much more likely to pull back because you don't have that confirmed opposing force. The DGAP filters for higher probability.
Okay, so ACS 28 gives us the playing field. The DGAP confirms a high probability divergence. But what about timing? How do we know if this move has oomph right now? Is it accelerating?
Good question. That brings in the second indicator, the advanced currency impulse with alert.
Impulse sounds like speed.
And that's exactly what it measures, the acceleration and the speed of the currency strength movement.
Yep.
If the ACS 28 is your map showing the overall direction.
Then the impulse is the speedometer and maybe the gas pedal.
Perfect analogy. It tells you how fast things are changing right now.
And the source material says this isn't just for confirmation, but it can actually spot the start of a big move.
Yes, that's a key function. It helps identify turning points and what they call the initializing trigger. When you get that DGAP set up on the ACS 28, you look to the impulse indicator.
And you want to see strong acceleration there too.
You want confirmation that the move has speed behind it. Often, the alert trigger for a potential entry comes when the impulse reading for those currencies crosses its own MFib 23 threshold.
Ah, the MFib 23 again, but applied to the speed reading this time.
Correct. So you get strength confirmed, ACS 28 DGAP, and speed confirmed, impulse. The system calls it a 1 + 1 = 3 effect, much stronger signal together.
Okay, let's talk about those MFib levels again, specifically the higher ones like 100 and 161. The system uses them to define trading zones, right? Inner and outer.
Yes, and the rules are quite strict depending on where the currency strength line is relative to these levels.
So the inner zone.
That's between MFib + 100 and MFib - 100. This is considered the main trend zone. Inside this zone, you primarily look for OGAPs, outside GPs.
Outside GPs, meaning GPs moving away from the zero line following the established trend.
Exactly. These are generally considered safer, especially for beginners. You're trading with the prevailing flow within its normal range.
And the outer zone, beyond MFib 100.
That's usually defined as beyond MFib + 100 or below MFib - 100, often extending towards MFib 161 and beyond. This is the reversal zone.
Because the currency strength is getting stretched, potentially overbought or oversold.
Precisely. And here's the critical rule. If a currency's strength line is already outside the MFib 100 level, you do not take an OGAP trade continuing in that direction.
Even if you get a GAT signal.
Even then, you're basically chasing the move at its potential peak exhaustion. The risk of reversal is too high.
So what do you do in the outer zone?
You wait for signs of reversal. You look for the CS line to start flattening or getting a hook curving back towards the zero line. Then you look to trade an IGB, an inside GP.
Trading the pullback, the reversal back towards the middle.
Yes. It's a counter-trend move relative to the immediate push, but potentially the start of a larger correction. These IGAPs require more experience.
It really forces you to respect when a currency might be running out of gas, even if the bigger picture trend seems intact.
It's built-in risk management based on market sentiment extremes, yeah.
Okay, before we get to trade management, there was a specific high-risk strategy mentioned for trading major news events, like FOMC. How does that work? It sounds intense.
It's definitely high risk, flagged only for experienced traders. The rule is, ignore the first few minutes of chaos right after the news release. Wait about 3 to 8 minutes.
Wait, most people try to jump on the spike immediately.
The system assumes that initial spike is often noise, maybe liquidations. After waiting, you use the impulse indicator, the speed one. You find the currency with the strongest positive speed impulse and pit it against the currency with the strongest negative speed impulse.
So you're trading pure acceleration versus deceleration post-news.
Exactly. Buy the fastest accelerating, sell the fastest decelerating. And the trade needs to work immediately. If it stalls or goes against you right away, you get out. No hesitation.
Wow, okay. A very specific momentum-first approach to news. Very different. All right, section 4. Let's talk management. Because a good signal is useless without it. Multi-timeframe analysis seems key here.
Absolutely non-negotiable, according to the source. The core rule is, identify the main trend direction on a higher time frame, but find your precise entry signal on a lower time frame.
Like maybe use the H4 chart for the overall ACS 28 trend?
And then drop down to the M30 chart to pinpoint that DGAP entry signal. Yeah. That way, you ensure you're swimming with the bigger current, significantly improves signal quality.
Makes sense. And money management. Sounds like they advocate being pretty conservative.
Very. Risking 1% of your account is considered the absolute max, with 0.5% being preferable per trade. Small, controlled bets.
And the stop-loss philosophy is interesting. No fixed pips.
Definitely not. They're quite adamant. Never use an arbitrary number like 30 pips. The stop-loss must be placed at a logical level.
What defines logical?
A level that, if broken, clearly invalidates your reason for taking the trade. Think a recent swing high or low on your entry chart, or maybe a clear supply or demand zone just beyond your entry.
So it's the point where the market itself tells you, nope, your analysis was wrong.
Exactly. If price hits that specific point, the setup is broken, get out.
And by placing that logical stop perhaps on the lower M30 time frame, how do you aim for a good risk-reward ratio with the take profit?
You typically look for your take profit targets based on levels from the higher time frame trend, the H4 in our example. This naturally creates asymmetry. Your risk, SSL, is defined tightly on the lower time frame, while your potential reward, PP, is based on the larger move expected on the higher time frame.
So you're aiming for better than 1.1.
Definitely. The goal should be to find setups offering at least 2.1, 3.1, or even higher, like 5.1 RR, by managing the entry and stop tightly relative to the potential target.
What about getting out manually? If a trade is running but maybe losing steam before hitting a big target, are there rules for that?
Yes, manual trade management is encouraged. You'd look for signs of exhaustion on the ACS 28 indicator.
Like what?
Like if the currency strength line suddenly changes direction, gets that hook shape we mentioned earlier turning back against your trade.
Okay.
Or if the CS line pushes out to an extreme MFib level, like 161, and the angle of the line visibly flattens out, that suggests the momentum is dying.
Time to take profits or tighten the stops significantly.
Right. It connects back to that classic advice. Cut your losses quickly, but find ways to let your winners run while still being aware of when the run might be ending.
Okay, so wrapping this up. This 28-pair system, the double GAP strategy, it really seems to offer a uniquely comprehensive view, boiling down the whole market onto one screen.
It does. It combines that broad view of currency strength from the ACS 28 with the precision timing of the impulse indicator to find these specific DGAP setups.
Giving you potentially a real edge?
Potentially, yes. The creator had a great quote. Using this isn't like switching from a bicycle to a car. It's like switching from driving to flying a helicopter. The view is totally different.
A helicopter view of the market flow. I like that.
But, and this is the big caveat, the tools are powerful, but they don't guarantee success. Success comes from rigorously applying the rules, especially the money management, the logical stops, managing the trade based on the flow the indicators show you. Discipline is everything.
Discipline applied to, hopefully, superior information. Makes sense. So we'll leave you with a final thought to chew on. If the Forex market is essentially a closed system, always in equilibrium, where total buying equals total selling across all currencies, how often does staring at just one pair, like Euro USD, trick you into thinking one side is definitively winning, making you miss the larger, underlying, and perhaps inevitable flow of money shifting between all 8 major players?
Thank you for watching this video. See the download link below in the description. If you like our hard work, please give us a like and subscribe for more trading tools and updates.